I know. I know. I always say this is an emergency broadcast. But this time, it actually is. Put the coffee down. Because if you don't, you're about to spit it out. What you are watching on the charts this morning is not trading. It is not economics. It is professional wrestling. Two guys in spandex hitting each other with fake folding chairs while the referee pretends not to see it. Welcome to the WWE takeover of the precious metals market. Ladies and gentlemen, Asian Guy here. It is Thursday, January 29th, 2026. If you woke up this morning and checked the price of silver, you probably thought your data feed was broken. Silver didn't dip. It didn't correct. It was assassinated. A vertical drop. Roughly $15 in hours. Gold wasn't spared either. Gold was taken out back and shot. Down $500 in a single session. And right on cue, the mainstream financial media is calling this a correction. They're calling it profit-taking. That's nonsense. Profit-taking is when a few traders sell to buy a new car. Profit-taking does not crash a market 15% in 20 minutes at 8:30 a.m. New York time. This was a hit job. A coordinated, algorithmic nuclear strike designed to do one thing only. Break your psychology. Now here's the smoking gun. This is the proof that this market is rigged, manipulated, and fundamentally broken. Normally, when gold crashes, it crashes everywhere. If New York sells, London sells. Tokyo sells. Everyone sells. That's not what's happening today. What we are seeing is something I have not seen in over 20 years. A full decoupling. A massive hole opening between the price of gold in the United States and the price of gold in the rest of the world. Let's look at the numbers. Because numbers don't lie. Bankers lie. Numbers don't. Right now, in New York, the paper price of gold on COMEX has been smashed down to around $5,200. At the exact same moment, London spot is trading closer to $5,580. Mumbai is around $5,550. Think about that. A $300 spread. $300 for the exact same asset. In a free market, this is impossible. Arbitrage bots exist to capture pennies. Pennies. They would buy cheap New York gold and sell it in London in milliseconds. But today, the bots are silent. The arbitrage isn't closing. The gap is just sitting there. Wide open. Screaming at us. What does that tell you? It tells you this is not a global sell-off. India isn't selling. China isn't selling. Europe isn't selling. Only New York is selling. This is a targeted attack on the COMEX paper price. A naked short flood. The entities that control the dollar saw the DXY collapsing. They saw confidence in fiat evaporating. And they chose to sacrifice the COMEX to defend the regime. They dumped billions in paper contracts during the New York session to paint a massive red candle. All in the hope that you panic and sell your real metal. They want you to believe your silver just lost $15 of value. It didn't. The rest of the world is paying a premium for it. This is a financial movie set. A fake town with fake prices. That $18 silver price only exists on servers in Lower Manhattan. It does not exist in Dubai. It does not exist in India's jewelry markets. It does not exist in China's factories. And if you sell your real metal based on that fake price, you are handing them exactly what they want. If you sell your silver today because of that New York price, you are falling for the oldest trick in the book. You are selling a global asset based on a local manipulation. And to prove it, we need to zoom out. We need to take a trip around the world. We need to look at what I call the tale of three cities. New York, London, Mumbai. Because the divergence between them is the signal. You cannot understand the magnitude of what happened this morning until you see the global scoreboard. Most investors live inside a bubble. They wake up, open an app on their phone, see gold down $500, and assume that must be the truth. They assume the price on their screen is the universal price of gold, valid everywhere on Earth. Today, that assumption is not just wrong. It's dangerous. Because today we are witnessing the fracturing of the global price. Economists call it market decoupling. I call it the tale of three cities. So let's start at the scene of the crime. New York City. This is the home of comics. This is the paper market. This is where large banks trade futures contracts that claim to represent gold and silver. After the WWE takedown we just watched, the New York close looked like this. Gold around $5,200. Silver smashed down to about $108 per ounce. If you are an American investor, this is your reality. This is the price your broker shows you. This is the price CNBC reports with a straight face. Now let's get on a plane and fly across the Atlantic. London. London is the hub of the physical trade. This is where real metal changes hands. And right now, London is telling a very different story. Gold in London is trading closer to $5,580. Silver is trading around $117. Stop and think about that. Silver is $9 higher in London than in New York. That's nearly a 10% premium. Same metal, same atomic number, same ounce. But in London, it's worth significantly more. And if that doesn't get your attention, let's keep moving east. Mumbai, India. India is the heart of global retail gold demand. The Indian housewife is one of the most disciplined gold buyers in history. She understands value. And today, the Mumbai price says this. Gold around $5,559. Silver roughly $118. Now look at the spread. Between New York and Mumbai, gold is over $350 apart. Silver is about $10 apart. That is not a rounding error. That is a canyon. And I need you to understand how impossible this is in a functioning free market. We live in the age of high-frequency trading. There are supercomputers sitting in New Jersey designed to detect price differences of 1 penny. 1 cent. If gold is even slightly cheaper in New York than London, those machines instantly buy New York and sell London until the prices match. That process is called arbitrage. It's the glue that holds the global financial system together. But today, the glue melted. The spread is hundreds of dollars, and the bots are silent. So ask the obvious question. Why aren't banks buying gold in New York at $5,200 and selling it in Mumbai at $5,500? They could make billions, risk-free, in a single day. Why aren't they doing it? There is only one explanation. Because the gold in New York isn't real. The arbitrage isn't closing because you cannot reliably get physical metal out of comics fast enough to sell it overseas. The market knows that the $5,200 price is a paper price. It's the price of a digital contract, not a bar of metal. It's a contract that will likely be settled in cash, not gold. And that's why the rest of the world is ignoring it. If you tried today to take delivery of 10 tons of gold in New York and ship it to India, the exchange would tap you on the shoulder and say, "Sorry, we can't do that." And that tells you everything. The arbitrage is broken. The connection is severed. The U.S. market has become an island of lies floating in a sea of truth. The rest of the world, London, Mumbai, Shanghai, is trading real physical metal, and the price is high. The United States is trading a derivative of the metal, and the price is being forced lower to defend the currency. This decoupling is the most important financial event of the year. It means the US dollar has lost its power to set the global price. For 50 years, New York said jump, and the world asked how high. If New York smashed gold, gold fell everywhere. But today, New York smashed gold and India said no. We're not selling. In fact, we're buying. The dog is no longer wagging the tail. The tail has cut itself off. So when you see that violent red line on your screen, understand what you're really looking at. You are not watching the value of your wealth collapse. You are watching the credibility of the U.S. pricing mechanism collapse. This is a desperate attempt to paint a picture the rest of the world refuses to look at. Americans are selling paper to each other at $108 an ounce, congratulating themselves for taming inflation. Meanwhile, the rest of the world is buying real metal at $118 and laughing. And the biggest laugh is coming from the Far East. Because while London and Mumbai are trading at a premium, there is one place where the price is even higher. One place that treats silver not as a commodity, but as a matter of national security. China. We need to talk about Shanghai. Because the price there makes Mumbai look cheap. Right now, you can buy paper silver in New York for $108 and sell physical silver in China for $132. This is no longer a spread. This is the moment where decoupling stops being an academic theory and becomes a crime against American wealth. We've looked at London. We've looked at Mumbai. But if you want to see the future, if you want to see the true value of metal in a market that is genuinely desperate for it, you look at China. While New York bankers are high-fiving each other for smashing the paper price, the Chinese market is screaming for supply. And the price proves it. We've just received confirmed data from RTO Gold. This is not a pawn shop. This is China's largest state-sanctioned precious metals recycling and buyback network. If you want to sell silver in Shanghai, this is where you go. And today, their buyback price is 29,590 yuan per kilogram. Do the math. At current exchange rates, that's about $132 per ounce. Let that sink in. 132. New York is flashing 108. That's a $24 difference per ounce. A 22% premium. This is not a spread. This is a different planet. If you sell your silver in the United States today at 108, you are donating $24 per ounce to the buyer. For free. You are getting ripped off on a historic scale. And why is China paying this premium? Because they have no choice. The supply chain in the East has snapped. We need to talk about Shenzhen, the manufacturing hub of the world. The latest reports are getting worse. It has now been 15 consecutive days since major industrial fabricators have received any silver from the Shanghai Gold Exchange. The vaults are empty. The delivery trucks are parked. The factories that build electronics, solar panels, and batteries are sitting idle, waiting for metal that isn't coming. Panic sets in when a factory owner in Shenzhen realizes he might default on a contract because he has no silver. He doesn't care about the COMEX price. He doesn't look at New York and say, "The price is down, I should wait." He looks at his local market and says, "I'll pay 130. I'll pay 140. Just give me the metal." That is what's driving the $132 buyback price. This isn't speculation. This is physical desperation. China is experiencing a resource heart attack, and the only cure is to pull every available ounce of silver out of the global system. And this creates the ultimate arbitrage. Think about the mechanics. If you are a global bullion bank, JP Morgan, HSBC, one of the few players licensed to operate in both markets, you can theoretically buy paper silver in New York at 108. You can stand for delivery, if they allow it. You then ship that metal to Shanghai and sell it for 132. That's $24 of profit on every ounce. On a standard 5,000-ounce contract, that's $120,000. Risk-free. It's a vacuum cleaner the size of the Pacific Ocean. So here's the question. Why isn't the New York price rising to match China? Why is the gap getting wider instead of smaller? Because the paper masters in New York are fighting the tide. They are dumping paper contracts to suppress the U.S. price, trying to convince you that silver is losing value. But all they are really doing is making the arbitrage more profitable. By smashing the price to 108, they've effectively put a 50% off sale sign on American silver for Chinese buyers. They are subsidizing the transfer of wealth from west to east. Every ounce sold in the U.S. today at this suppressed price is an ounce that will end up in a Shanghai vault tomorrow. And once it's there, it's not coming back. You also have to ask a simple question. If the price crashed to 108, someone had to be selling. But more importantly, someone had to be buying. Do you think the Chinese buyers are scared of this drop? No. They're laughing. They're looking at the screen and saying, "The Americans are selling us strategic metal at a discount." Cargo ships are being booked. This crash is the greatest gift Beijing could have asked for. It allows them to refill empty vaults using the panic of Western investors. Now here's the twist. Normally, when a market crashes like this, the speculators pile in on the short side. Hedge funds smell blood. They short the market and try to drive it to zero. But that's not happening today. The data is showing something strange. The smart money is not shorting. Hedge funds are looking at that $132 price in China, and they are terrified to bet against it. They know that if the vacuum pulls hard enough, the New York price won't drift higher. It will explode upward to close the gap. So despite a violent crash, short interest is near zero. And that brings us to the short trap. We need to explain why banks are the only ones selling and why real money is standing on the sidelines. Because here's the most bizarre statistic of the day. When a market drops 15% in a single morning, it normally triggers a feeding frenzy. Short sellers pile in. Borrow demand explodes. Borrow fees spike. But today, we're looking at internal data from SLV, the largest silver ETF in the world. And it's telling us something that should not happen during a crash. That the smart money is completely absent from this sell-off. We checked the prime brokerage data. As of this afternoon, the fee to borrow shares of SLV is 0.53%. 0.53. That is essentially free. That is rock bottom. And the number of shares available to borrow? Over 10 million. Just sitting there. Nobody wants them. Nobody is borrowing. Nobody is shorting. Do you understand how insane that is? Silver just dropped $15. A historic collapse. And yet the speculators refuse to bet against it. Why? Because they're not stupid. The hedge fund managers in Greenwich and Mayfair are looking at the same global map you just saw. They see $132 silver in China. They see 118 in Mumbai. And they see 108 on a New York screen. And they know that shorting silver here is like standing in front of a freight train holding up a sign that says stop. The freight train is physical demand from the east. And if you stand in front of it, you don't get rich. You get run over. This tells us exactly who caused the crash. It wasn't the market. It wasn't speculators. It was a tiny handful of bullion banks. Probably 2 or 3 institutions dumping their own positions to force the price lower. They are the only ones selling. They are naked shorting, selling contracts they don't have, because they are desperate to cap the price, protect balance sheets, or defend the dollar. But they are alone in the trenches. The cavalry isn't coming. The rest of the financial world is standing on the sidelines, watching, because the smart money knows this $108 price is a coiled spring. The moment the selling stops, arbitrage wakes up. The moment pressure lifts, the price doesn't drift higher. It snaps. Back to 118. Back to 132. And if you're short when that happens, you're finished. That's why this crash is artificial. It's painted tape. It exists to scare you, the retail investor, out of your position. They want you to see the red line and panic. They want you to sell real shares, so they can buy them back and cover their naked shorts. But institutions aren't falling for it. They see 10 million shares available and say no thanks. That rail is electrified. And here's the ultimate irony. Even the banks themselves are quietly admitting this game is over. Publicly, they're smashing the price to 108. Privately, their own strategists are publishing price targets that would make a gold bug blush. We need to talk about JP Morgan. Because while their trading desk is hitting the sell button, their research department just put out a note projecting gold at $8,500. Let that sink in. Same bank. Same building. Two completely different realities. This is where the story moves from manipulation to institutional schizophrenia. If you want to know what the banks actually believe, you don't watch what they trade. You listen to what they tell their high net worth clients behind closed doors. There is a wall between the trading desk and the research desk. The trading desk is paid to make money today. They smash prices, run stops, and fleece retail. The research desk is paid to be right eventually. And right now, the biggest bank on the planet is suffering from a severe split personality. On one hand, gold is being slammed $500 in what looks like a textbook naked short attack. On the other hand, at the exact same time, a research note has just hit the Bloomberg terminal from JP Morgan's lead global strategist, Nicholas Panagurtsoglu. This is not a YouTuber. This is not a blogger. This is not someone selling fear and canned food. This is the voice of the establishment. So what is his forecast? Is he calling for gold to collapse? Is he saying the bubble has burst? No. He is calling for gold to surge toward $8,500 per ounce. I want you to hold two numbers in your head at the same time. The screen says 5,200. The bank says 8,500. That is a 63% upside from here. And why is he bullish? Not because of war. Not because of shortages. Because of one terrifying structural shift. Allocation. Panagurtsoglu points out that private investor allocation to gold has risen to 4.6%. To most people, 4% sounds small. In global finance, it is enormous. A move from 1% to 4% represents hundreds of billions of dollars rotating out of paper assets and into hard assets. The bank understands this. They know pension funds, sovereign wealth funds, and family offices are losing faith in debt. They fear inflation. They fear currency debasement. And they are quietly changing the dial. So here's the dirty secret. JP Morgan knows gold is going to 8,500. They know 5,200 is a joke. So why smash the price today? Because they're accumulating. They are playing a double game. They use the paper market to crush sentiment, to manufacture fear, to shake retail investors out of ETFs so they can acquire physical metal at a discount before the inevitable run. This is a classic Wyckoff spring. A terminal shakeout. They push the price below support, trigger stop losses, flush out weak hands, and generate the liquidity they need to build long positions. They are not shorting because they think gold is worthless. They are shorting to buy time. They are holding the price down so they can load inventory cheaper. If the price jumped to match London today, they would have to pay more. So they suppress it and become the buyer of last resort. When you see the 8,500 target, understand this. That is the bank's real destination. 5,200 is just a pit stop. And if you get off the train here, if fear pushes you out of your seat, you'll be standing on the platform watching generational wealth roll away. You have to look at the world price, not the rig price. You have to look at 132 in China, 118 in Mumbai, and understand that 108 in the US is a temporary hallucination. A glitch. And glitches don't resolve gently. They resolve violently. Now we need to give the final verdict. Because selling now is not neutral. It is a transfer. So here it is. We just walked through the crime scene of the century. We examined the fingerprints. We identified the weapon. We named the victim. The victim is U.S. prize discovery. It has been bludgeoned by a coordinated attack designed to manufacture a false reality. We are now living in a decoupled world. A world where arbitrage no longer functions. Where geography matters. Where paper and physical are no longer the same thing. And in that world, one truth stands above everything else. The metal didn't lose value. The price lost credibility. Determines your wealth. You have 3 choices today. 3 realities. Reality number 1 is the New York price. This is $18 silver. This is $5,200 gold. This is the fake reality. A price set by paper contracts, pushed around by algorithms, and suppressed by banks terrified of losing control of the dollar. It is a price where you cannot take delivery in size. It is a mirage. Reality number 2 is the world price. This is London and Mumbai. $118 silver. $5,500 gold. This is fair value. This is where physical metal actually changes hands between rational buyers and sellers. This is the real global consensus before manipulation interferes. Reality number 3 is the China price. $132 silver. $5,600 gold. This is the hard floor. This is the price of desperation. This is what happens when 1 billion people are sitting on empty inventories. This price acts like a black hole, pulling metal out of the West. And here's the tragedy. Millions of Western investors are looking only at reality number 1. They see a $15 drop in New York and they panic. They sell. And who is buying? Reality number 3. Every time an American investor sells SLE or dumps physical metal out of fear, an arbitrage desk or a state-backed Chinese buyer is quietly taking the other side and shipping that metal east. This isn't just a bad trade. It's a transfer of generational wealth. You are selling your insurance policy to the people who are preparing for the fire. And you're doing it for $24 less than it's worth. That $300 gap in gold and $10 gap in silver is the first crack in the dam. It tells us that comics and the London bullion market are losing control. They can smash the paper price. They cannot smash physical demand. If they hold silver at 108, the vaults will empty faster. Low prices cure low prices by destroying supply. By making silver artificially cheap in New York, they are guaranteeing there will be no silver left in New York. So here is the final warning. Do not let a red candle in the New York session shake you out of a green reality everywhere else. Do not be the easy mark at the table. If JP Morgan thinks gold is going to 8,500, why would you sell at 5,200? If China is paying 132 for silver, why would you sell at 108? Use the manipulation. If the banks want to put metal on sale, let them. This window will not stay open. Eventually, arbitrage will wake up. Eventually, inventory will run out. And when the prices reconnect, they will not meet at 108. They will meet at 132. And then, they will move higher. This is John. The game is rigged. The spread is real. Don't sell to China.